Hello, everybody. Wanted to check in. There's a lot going on with the market these days. We're in the midst of review season and trying to get together with our clients and share what we're seeing, making portfolio adjustments when necessary. We've been getting some pretty good feedback on our overview of the market and where we believe things are going. So just figured it would make sense to share as a video. I want to start with just our investment philosophy. And I think, if you go back to 1970, $10,000 invested in the S&P 500, would have grown to $2.6 million today. And there have been a lot of reasons to potentially sell your equities over the years. Many of them don't send the market downward. You never really know exactly what's going to drive the market downward. Clearly, the market has been reacting to the tariff talk, a lot of things going on with the administration. And so, look, I think now is a really good time for any investor to review their portfolio, understand how much risk they're actually taking, and determine should you raise a little bit of cash, should you tweak around your asset allocation to be a little bit more protective if things end up dragging out here, in the months ahead. So really, really good time to be reviewing things with your advisor. When I look at equities, obviously there's been volatility, but what are your alternatives, right? If you've been sitting in cash, I would love for my clients to feel really safe right now with their money. If you're in cash, in some cases bonds, right, you've lost 25% of your purchasing power since 2020, right? And if you look at cash over the long term, since 1913, the Federal Reserve was put into place, and really just until 2021, the dollar's lost 96.3% of its purchasing power. Money supply in 19 today we're at over $21 trillion in terms of M2 money supply in the U.S. That's what sort of that's a dilution of your dollars. So I think one way to conceptualize holding cash and bonds in your portfolio is, look, if you're getting good yield on your bonds, on your cash, and that yield is higher than the rate of monetary inflation or the rate at which the government's printing money and diluting your dollars, then you're okay, right? If you're not getting enough yield, right, from 2008 to 2020, interest rates were very, very low, you weren't really keeping up with the rate of dilution. And so if you were above the line here, all right, you're getting enough yield to kind of offset the dilution that the Federal Reserve is doing as they print dollars over time since the great financial crisis. You've been net not earning a real rate of return, and that's especially been true the last couple of years since COVID. So I just think, for me, I think some of these issues appear like they're going to be short-term in nature. I'm going to get into the tariffs and what I think the administration is trying to do. I think it's just helpful for investors to think about, all right, where do I really want to have my long-term capital? I'm not so sure I love the idea of going too much, shifting too much away from risk assets that can protect us from inflation into cash and bonds, because I'm not so sure that you're going to get a real rate of return moving forward. I'm going to cover why in a minute. It's a really good thread on the ins and outs of the tariffs. I think most of my clients, this was new information to them. I think most people are vaguely aware that the national debt has been rising. We're at 36 trillion in national debt. I think most people aren't necessarily aware that 9.2 trillion out of the 36 trillion in debt is coming due, is maturing this year. And so when I look at what the government's doing, and I know it's kind of scary when you hear Trump say he's not even looking at the stock market, doesn't really care what the stock market does in the short run. I think what they're trying to do is to get interest rates down so that they can try and refinance this debt out into the future at a more cost-effective rate. When I look at, the fiscal year for the government starts on October 1st. So year to date, since October 1st for the federal government, they've taken in 1.8 trillion, 1.9 trillion in tax receipts. They've spent $3 trillion. So we're on pace to run these crazy deficits. And so, what's $36 trillion today is probably going to be 38 to 39 trillion a year from now. It's pretty scary stuff. When you look at the rate at which annual interest payments are increasing, that's definitely not a good thing. And so Peter Schiff actually, and I guess you can kind of see it, you can see it here too. We've got 9 trillion coming due. We've got a whole lot of debt maturing right behind that. According to Peter Schiff's research, over the next 4 years, we've got 28 trillion of the 36 trillion in national debt maturing. If they continue to run $2 to $3 trillion deficits every year, you're going to add another 10 trillion. So how is the U.S. going to sell effectively? That's what they need to do. They need to sell treasuries out in the marketplace. I'm not so sure how much China, Russia, the Middle East really wants to be holding our debt relative to real assets these days. So, 10-year treasury, 4%, 4.3%, are we really going to be able to sell 38 trillion of treasuries? Or is that interest rate going to have to go up to be able to sell that debt? Or is the Fed going to have to buy up the inventory, right? Are they going to have to print tens of trillions of dollars? We just saw during COVID, the massive inflationary effects of the Fed printing $6 trillion, right? So how are they going to sell this debt? Are they going to have to print north of 6 trillion, north of $10 trillion just to keep themselves afloat? It's kind of hard to fathom. But if you're sitting in bonds and cash, which have virtually no inflation hedge, and the government has to print all this money, that's going to be a problem for you. So, while I do think in the short run, investors should be conscious, aware of the risks, and look, free up any cash that you need for spending over the next 6, 12, 18 months, certainly that makes sense. I would be deathly afraid to de-risk my portfolio too much, knowing that this is coming, right? So Fed's meeting today, will they cut? I don't believe that they're going to cut rates. The real question to me is, we've had quantitative tightening over the last couple of years. The Fed has been trying to shrink their balance sheet. I think a lot of people think at some point in the next handful of months, they're going to stop quantitative tightening because they need to kind of protect the economy. And at some point, they're going to flip to quantitative easing again. And that's sort of because of just kind of what Peter Schiff has laid out here. And so I'm a big believer, right? Gold prices have not expanded at the rate at which treasury supplies have expanded. So I do think holding some real assets makes sense. Anybody that follows us knows, we enjoy educating investors on Bitcoin and why Bitcoin makes sense. Bitcoin has been very correlated to, in this case, global M2 liquidity or money supply, right? If we think that the money supply is going to have to get expanded, Bitcoin has historically been a pretty good hedge against irresponsible government spending and money printing. So, look, just wanted to give people a quick look behind the curtain at some of the things we're looking at. I think for any investors out there, now is a really good time to be reviewing your allocations and thinking about where the puck might be going, what portfolio tweak should we be making. So, hopefully this was helpful, and we'll be trying to put out some more content here in the coming weeks and months as it continues to evolve. All right, take care, everyone.